My role is to make sure that those highly underserved people by mainstream finance can find a legitimate source for their borrowing need.
Hi all, so very welcome on Aulium. Markus, here you are again. Very nice to be with you.
Good to be
Today,
back.
I mean, we are super pleased to have Aymeric from LoanTube. So a broker, a platform based in the UK, and we really can't wait to discover more about LoanTube and essentially your journey, Aymeric. So hi Aymeric, and thank you for being with us.
Thank you both of you for having me. It's an absolute pleasure.
So maybe we can start by like a very simple question. Can you explain to us what LoanTube is? I mean, what it does, like maybe like some basic case studies or like processes, etc. That would be superb to essentially set the frame.
With pleasure. So let me give you the answer that I offer to Gen Z. I tell them that we are the Tinder for loans. So we don't lend money, but we are a matchmaker. We help consumers find relevant loan offers and vice versa. We help lenders find suitable consumers. And we are doing the matchmaking in the middle.
Okay, doc. And so anything like specific about it?
Yes.
In terms of technology, I mean, that was super simple terms. Maybe if you can use a bit more elaborate terms, that would be great.
Of course. So you have many different types of loans. You can use a loan naturally to buy a house, which would be called a mortgage. We focus on personal loans. So this would be on the smaller end. Think £500 to £5,000. Typical use cases would be to pay a bill, to go on holiday, to maybe renovate a portion of your flat or your house. The average loan size that we see across our platform is about £2,000. And the way we work is we're exceptionally tech savvy. And actually, just before I tell you how we work, think of us as a price comparison website, a bit like Skyscanner for flights, but with a specific focus on personal loans. So what we ask that you do is that you fill in an application form. In the application form, you will provide information pertaining to who you are, where you live, how much you earn, the composition of your household. We will then augment that information with a soft credit check powered by Equifax. And what this simply means is that Equifax will tell us how much debt you currently have outstanding. And if you have any adverse events such as CCJs, bankruptcies, IVAs, we will then interpret this information and use it to match you against relevant lenders. So what we don't do is we don't send applicants to every lender that we work with. We would be completely unnecessary. More importantly, we would be overwhelming their servers. So we do a ton of pre-qualification. And when we feel that the likelihood that you match a lender's particular appetite is high, we will then send all this information to the lender with the view to get an immediate answer. Yes, I would like to lend to this person. Here are the terms of the offer. And by terms, I mean amount, term, and cost.
Okay.
All this.
And so,
sorry.
Mm-hmm. No, I was going to ask, like, in terms of lenders, who are they? I mean, we are talking banks, or we are talking like smaller entities. Who are they on? I mean, so there is the consumer side, and on the other side, like, I mean, who are your generic lenders or general lenders?
Yeah. So we launched in 2019, and we were the country's first real rate personal loans marketplace. Believe it or not, even your money supermarkets, your Go Compares, your big platforms out there were not serving live loan offers in the personal loans space. So you could compare live insurance offers, you could compare live utility bill offers, but not in the personal loan vertical. So we were the first to bring this concept to market. Because it was naturally a great idea, everybody followed very quickly. But we didn't give up. And what we realized is that the big platforms out there, they tended to serve prime consumers. Prime consumers, simply put, are people who have a good credit profile. They earn a lot. they have limited debt, and that there's this huge population, which today we're talking about 33% of UK adults, that is completely marginalized by mainstream finance and the big platforms. And we call these types of adults non-prime adults. So you may have heard of the term subprime, near prime. The two together constitute near prime. And so we have decided to become these people's champions. So we have purposely onboarded lenders that have a higher risk appetite. So to go back to your question, we don't work with lenders, with high street banks. High street banks don't want to serve this type of audience. So we work with specialist lenders. I have to, of course, emphasize, they are fully FCA regulated. And by the way, so are we as a platform. So there's, this is not a, Far West or El Dorado where anyone can do anything. It's a highly regulated, and things need to be done in a very strict fashion.
Yeah, that's super interesting. Thanks a lot for explaining that in more detail. And, you were mentioning a few names there, Money Supermarket, for example. Just generally, it seems like, in the UK, there's a lot of outstanding consumer credit. I think it's something like 150 billion and 2 in 5 adults using BNPL. So with the rates still pretty high at the moment, what do you think that the borrowers are looking for right now?
Sure. So it's very good that you bring this to light, because the one thing that makes the UK and the US stand out is that both countries are very much credit driven, much more so than, for example, your typical continental European country. I was recently in Geneva, and people had never, where I presented the LoanTube to a group of tech people, and they had never heard the term non-prime. And that's because in continental Europe, credit is not necessarily seen as a force for good. Whereas in your big Anglo-Saxon markets, credit is very much seen as something that can help you achieve a goal. So there is much more, both countries, the US and the UK, are much more credit driven, which is the reason why the non-prime segment is also served. These are people who typically have either irregular income or highly indebted or are recent migrants to the country. And the rates offered to them can start at around the 25% mark and go all the way to the 250% mark. So actually, that industry is slightly less dependent on rates themselves, given the huge spread between the base rate and, the let's say, the risk-adjusted pricing.
So there is also like some sort of ethical question about it, where, we would come back to that a bit later. But for you, we've seen over the past months, years, rates going up. Was it a good thing for you? One would think that, consumers may try to essentially bundle and sort of refinance, etc. Was it something you've seen? Is it do you think, sorry, second question attached to that, do you think there is some sort of healthy trend? Because debt is great, but too much debt can be catastrophic.
Absolutely. So like everything in life, it's about striking a fine balance between having access to opportunities, but not exceeding the thresholds that take you over the edge. The rise in rates had an indirect impact on most UK households, because naturally people who have mortgages, the price of their mortgage was directly linked, and so they would have had to fork out significantly higher every month, higher sums for their mortgage than in the past. And that had an immediate impact on their cash flow situation with the household, meaning that, for example, they could no longer afford to go on holiday or without borrowing, or they could no longer pay a winter bill. So if anything, it did accelerate demand for loans, and we're seeing record demand for loans. And we believe that nothing will stand in the way for that demand to continue growing.
So that makes a lot of sense. LoanTube itself positioned itself around fairness and transparency. I think that's a big element that you talk about a lot on your website. So why is that in particular important today? So why is it important to be very transparent and fair with consumers, especially in, let's say, non-prime or subprime lending categories, for example?
Sure. So these people are, I don't want to say they live paycheck to paycheck, but they're close to living paycheck to paycheck. And also they don't have significant savings. You could very easily identify certain events during the year that a typical family is subject to, and I'm talking about ad hoc events. Like, for example, back to school, you have to buy school uniforms. Around Christmas, you have to prepare for the Christmas festivities, and then towards the summer, you want to take your kids ideally on holiday. What we want to make sure, going back to what Thomas alluded to, is that people, first of all, only borrow responsively. So they borrow really when they know that it's actually a positive event. It's an event, ideally, that will generate positive ROI and that they can afford. The good news is that the industry also has evolved significantly. You may remember players like Wonga that were very, very big in the space 15 years ago, back when the industry was unregulated. The regulator has since ensured that affordability checks are done for anyone looking to borrow money. And simply put, an affordability check means that everyone that gets a loan offer needs to be able to afford that loan offer, to pay back that loan, irrespective of the relative costs. If you as a lender today are deemed to lend to people without doing a proper affordability check, you risk losing your license overnight. So these lenders that, yes, do offer APRs in the 25 to 250% range, which, for someone working in the city is something unfathomable, but it's the reality of at least 1/3 of UK households. They must afford it in order to get the loan. So we at LoanTube, we pride ourselves in making sure that we don't just use headline figures like APR, but it's clear if you take a £1,000 loan at a 79.5 APR, it's clear to you that you're going to have to pay back the £1,000 principal, and on top of that, £350 of interest, and how that is split across the term of the loan. Because one of the things that they don't teach you in school is basic financial literacy. So we want to make sure that irrespective of whether you are financially literate or not, it's what you see is what you get, and you don't need a PhD or you don't need to have gone to university to be able to make a simple decision. Yes, it's for me. No, it's not for me.
Yeah, that's really interesting. You mentioned that, and you mentioned, Wonga, for example. I think everybody's heard, I guess, some horror stories from back before it, when it wasn't as regulated. So just a follow-on question for me is, what's changed in the past 10, 15 years in that industry? What in particular has changed from a regulation perspective to stop these, I guess, horror stories from happening?
Yeah. So because we live in as free market as one can imagine, maybe outside of the US, Wonga was quite simply serving a niche, or a very big niche. There was huge demand for smaller loans. Back in the days, those loans would be called payday loans. Today, it's no longer acceptable to use that term. So the new term is high cost short term. Would, in its heyday, underwrite £80 million of loans in any given month. It was very easy to borrow £100, £200 in advance of your next paycheck. However, they also made things too easy, arguably, so they actually mastered the user experience journey. But what ultimately led to their downfall is that they didn't pay particular attention to people whose situations would changed overnight. The fact that you can afford today a loan doesn't mean that tomorrow you can continue affording it. And in such instances, instead of offering, let's say, a restructuring of the loan in order to enable you to get out of that loan, they would impose an immediate fine on you for not paying the next installment on time, which ultimately would result in your loan being rolled over in perpetuity. So let's say a £300 borrowing could literally become, given the rates and the thousands of percent, because it was very short term, could end up at £3,000. And that, let's face it, is not an acceptable outcome in general. So the regulator, again, a bit slowly, because they had to take their time, they prevented or they have now prevented such outcomes from ever happening again. Because if someone's circumstances change such that they can no longer afford the loan that they could originally afford, the lender is forced to proactively reach out to them and find a solution that helps them take out of debt, which, to be quite frank, I think is still a good outcome because the lender will still get their money back. They may not earn as much as originally expected, but at least they will still get their money back, and the consumer will still have to pay a certain cost for having access to that privilege.
And so,
Thanks.
talking about the regulator, like who is responsible to check if the person can repay the debt? I mean, if so, let's say like someone comes to LoanTube, you find like a lender, like a deal is done, and then someone realized that the borrower like couldn't essentially repay in the very first place. And who is responsible? I mean, would it be you because you had to check if the person was able to repay? Is it the fault of the lender, or is it the fault of the consumer?
Yeah. So the ultimate underwriting is done by the lender. So it's the lender that makes the ultimate decision whether to lend to individual or not. Our role consists of pre-qualifying. So we do not, while we help lenders make that assessment, from a legal perspective, ultimately, it's the lender that is liable to and should the FCA decide to do an inspection, to demonstrate that every customer that they lend to at the time of application could indeed afford the loan. The beauty is that these affordability checks have been significantly empowered by the arrival of open banking. Open banking came into life, I believe, in early 2018. Like any new technology or any new tech-led process, it takes a while, to be adopted. 8 years later, I'm talking today, everybody understands the power of open banking, and as not only lenders use open banking, but consumers understand why. By giving access to prospective lenders to the last 12 months of their bank account details, it helps those lenders make the best possible assessment when it comes to affordability. And the good news is that you may not be able to afford a £2,000 loan, but you can potentially afford a £1,000 loan. So there's an additional benefit of sharing access to this data.
So you mentioned open banking, like game changer. For you, your value to the lender is because you bring qualified leads. So I'm sure you check in advance if the person is able to contract a new loan or not. Do you think you could explain what are like the key criteria? So you get access to open banking, so the different bank accounts of the potential new borrower. What are you going to check in principle? I mean, I'm sure it's mostly done by a machine and by your platform. What are the key criteria to essentially make sure that someone is able to repay?
Absolutely. So there's dozens of criteria. It does indeed. Let me actually start by saying that today, so 6 years after launch, we process 12,000 applications daily. So on a monthly scale, we're talking about in excess of 360,000 unique applications coming from unique individuals. So it's which speaks to the huge level of demand, but also the huge level of data that we ingest on a monthly basis. And so, firstly, is how much do you earn? Some lenders will only be happy to lend to people who are in full-time employment. That could be an important criteria. Thankfully, some lenders are happy to lend to people who are not in full-time employment. Benefits for some lender will be seen as a positive attribute because it's a guarantee source of income irrespective of whether you are employed or not. For other lenders, it will be seen as a negative signal because it will suggest that you're overly dependent on the state for your well-being. But it always starts with income, then outgoings, and outgoings essentially means your living costs. So do you own the house? Because being a homeowner typically is being seen as someone that is a bit more responsible with their money. How much is the monthly mortgage? Or if you're a tenant, how much is the monthly rent? And then the composition of your household. If you are married but have no children, you typically have more capacity to borrow than if you are married and have 4 children. So those are let's say the key initial criteria. And then they look into your spending habits. So they want to see if at the end of every month, you still have some money left in your bank account. That's a very positive attribute. And equally, spending on stuff like gambling. The good news is that gambling is very much acceptable. What's not acceptable is gambling too much. And this is where every lender will have its own definition of what's acceptable. It could be 10% of your disposable income. It could be 5% of your disposable income. So our role is to do all these checks in advance for the lenders so that they only see the type of customers who in principle they should be lending to. But ultimately, they have a few additional criteria that they will keep to themselves, which is the reason why we will never be able to pre-qualify 100% of the time, but the ultimate underwriting decision is made by them.
Okay. So just going back to regulation, do you see it more as something very inconvenient for you because you need to change and, adapt, etc.? Or do you see it more as, some sort of barrier to entry, which makes your business more and more defensible in nature because it becomes more and more complicated to essentially launch something very similar?
It's the latter, Thomas, but I would start by saying regulation is a great thing because it ensures that indeed the industry doesn't exaggerate too much. Unfortunately, regulation tends to lag, tends to come later than it is than it should. But from today's standpoint, disregarding how the new regulation, how quick it came into force, is very much a good thing because it ensures that only the people that genuinely can afford to borrow, and consequently, this constitutes a formidable barrier to entry from our perspective and therefore offers a certain, moat. I would argue that aside from regulation, our biggest moat is the fact that since our launch in 2019, we have now processed the applications of over 7 million unique UK adults. And so we have an enormous amount of data that that have allowed us to refine our, for example, lead buying algorithms to make sure that we can not only serve the intended purpose, but we can do so in a profitable way, because ultimately we also have to make sure that our bills are covered at the end of every month.
Understood. Maybe like looking back at your own profile. So, you're half French, half Polish. You've been living in the UK. You set up businesses in Poland, in the UK. And how do you see the European sort of ecosystem in terms the tech ecosystem? Maybe comparing the three countries best. So Poland, France, and the UK. Have you seen things move? Let's say over the past 10 years, and in what way?
Yes, very. Actually, I have some very strong personal observations. So they are as follows. So as you rightfully noted, I have this dual heritage, but I came to the UK for university in 1999 at the age of 18. And after my career, like you, in investment banking, I felt that I was more suited to more entrepreneurial type of professional context, which is when in 2011, I decided to move to Poland, which was the only EU country to have escaped a recession following the global financial crisis. And I built my first business there. And at first, I felt that as a relatively new democracy and new free market economy, Poland lacked a bit of sophistication. But from today's markets, especially when it comes to access to pools of money and investment, but 15 years later, today, having built both businesses in Poland and the UK, actually Poland had one phenomenal advantage. As a new country, it means the majority of people who have made money and who are successful entrepreneurs are first-generation entrepreneurs. I call them nouveau riche entrepreneurs, and in the positive sense of this word, which means that they have had to themselves work super hard to make it work, and they are much more likely, therefore, to give back to and nurture the next generation of entrepreneur. And this I find quite similar to the philosophy in the United States, where a lot of investors were themselves entrepreneurs. When I came back to the UK in 2019, while We're surrounded by exceptionally sophisticated people, beautiful history. The one thing that I had underestimated is that not as much money proportionately was made by first generation entrepreneurs. And therefore, raising money here was actually more challenging because it was more, again, talking about my personal experiences, was more dependent on FOMO than actually on someone seeing huge potential in you and your attitude. Because let's face it, in an early stage business, the odds are massively stacked against you. So you should really be investing in the founding team. Because if the founders are dedicated and crazy enough, they will find a way to make something happen. It may not be the original idea, but it will be a pivot. Whereas if you overly focus on vanity metrics and, you know, what universities they went to or where they worked earlier, you're going to completely miss that point. And I believe you'll get disappointed more often than not.
Okay, and so if you had to rebuild your business today, I mean, what country would you pick based on what you just said? Like, I mean, would you remain in the UK or would you go back to the continent? Maybe start something in Poland because it's a bit more sophisticated now. Or, I mean, being French, I mean, would you go to France, even though at the moment it's a bit... it's
Good question. So I don't see it that way. I understand why it's the question. I don't have any regrets, even though my entrepreneurial journey has been full of ups and downs. I don't think in the category, I'm very happy with what I'm doing right now in the country that I'm doing. I think the UK is not only probably the best place to launch LoanTube, but it's also a fintech hub and so has very a deep set of investor pool. I just think it's really, you just embrace the opportunity. So if you have French heritage and you have strong French connections, it's more likely that it feels like it would be easier to set up shop there. The one thing that Poland maybe lacks is we have the impression as Poles that it's a relatively big country. It's about 38 million people. And that is why we feel like catering to the domestic market is in itself a good ambition. When our immediate neighbors, so Lithuania, Latvia, and Estonia, they know from day one that like serving the home country will lead to, you know, nowhere. So they have to apply this sort of global mindset from day one. So Poles or Polish entrepreneurs and the Polish funding landscape is slightly more challenged if you're looking to build a cross-border business. But ultimately, it's down to, you know, your contacts, where you feel most at ease, and where you find the opportunities to disrupt.
That's true. And so, like moving back to the business side, at LoanTube, what is essentially your North Star metric or metrics? I mean, what are the economics you follow on a daily basis, really? Or how do you track things and to ensure that you are growing? But you mentioned also that you need to pay the bills at the end of the month because for now you are still bootstrapped, so you haven't raised, so the business is healthy in that sense. What are you tracking to make sure there is like the right engine for you at the moment to grow and to remain profitable?
So our business at the moment quite simply consists of a lead gen arbitrage. So we spend a lot of money in the hundreds of thousands of pounds every month to make sure that loan seekers in our category, non-prime, they come through LoanTube, as we don't yet benefit from a strong brand name such as Google. So organic traffic is very much limited. So what we need to make sure is that our lead gen activities, which we do across every possible digital channel you can imagine, so this would be social media, this would be Google, this would be working with affiliates, is optimized. And that optimization means that we maximize the likelihood that the leads that we buy not only convert into offers, but convert into funded loans, because we only get paid when an introduced customer gets funded. And this is why also lenders love working with us, because working with us costs them nothing until we bring true value to them. But it makes setting up a business like ours very challenging. And And so that is why ultimately the brains of our business are the algorithms that allow us to determine the relative value of an applicant from at the moment that they apply, and on that basis assess whether we should be doubling down on this type of applicants or not. And we keep refining them. And that is why it's not, the concept of our business is very simple, getting it up and running and making it work is very difficult. And I take limited credit for this, because the one thing I'll add is I joined as co-founder 2.5 years ago. The business was originally founded by my business partner, who's of Indian heritage. And he set up this operation pretty much by himself with a small team out of India, and through sheer determination, perseverance, and attention to those details I just alluded to, managed to make the economics work. When I joined, the foundations were laid. I have been helping the business scale further, and we're looking to not only double down and grow further in the UK, but we have aspirations to launch in 2027 on the other side of the pond.
Oh, it's very exciting.
Thank you, Markus.
Yeah, that's a big jump across the pond, and a huge market over there as well. So I'm sure it'll be an exciting journey for you. Quick question: you were mentioning the moat, so competition, marketplace, and especially as well if you're moving into a new market like the US, which is really big with lots of competition. How would you say your moat is? Where do you say it sits, and how do you defend it versus your competitors, for example?
Yep. So we are a bootstrapped business. That's also one thing that I must emphasize. So we never benefited from access to deep pockets, which facilitate market conquering activities. So that is why my business partner, when he set up the business, he had to focus with relentless precision on unit economics, which means he could only onboard lenders, partners, who were willing to pay their fair share for the work that we were doing. And when you are just entering the market, those negotiations are naturally more challenging than they are today, when you already have a certain level of reputation and people know that you're good at your job. So because of this inability to rely on, third-party money or third-party brand, we refined our algorithms and to the extent that they're extremely efficient, and we are now able, with some, if we were to raise some new money, to scale much more rapidly, potentially across also adjacent verticals. And I'm not trying to say that we want to sell insurance, but until now we've been focused on your traditional term loans. We've literally just launched credit card offerings, and nothing stands in the way for us to also go down the high cost short term or, buy now, pay later hybrids. We're called LoanTube for a reason. We want to be the biggest and most efficient loan seller, as we call it, in the Western Hemisphere. And by Western Hemisphere, I mean UK, followed by the US.
Yeah, that makes sense. Just out of interest, you were briefly mentioning, so you bootstrapped a business that's part of your moat. And actually, my first business was also bootstrapped. So I know it can be very difficult. It's an interesting journey, and you've got to be very, very, very tight on cash. What are your suggestions for any founder who'd like to bootstrap their business, and how did you actually go about successfully achieving that?
So to be fully frank, not everyone can bootstrap the business, because not everybody, for example, had the benefit of working for a few years and being able to save money. But to be quite frank, the habit of setting money aside for the future is in itself a very important trait that I would encourage any entrepreneur to have. So you may not feel ready for the entrepreneurial journey today, but if you are tempted by it, live frugally and make sure that you have as large a personal war chest as possible for the future, because that means you can go longer, further, and you can keep much more of the business to yourself than if you are overly reliant on external capital from day one. But the truth is, and this was the case with my second business, which wasn't a success, is that not every business is the same. And this is also what I find quite frustrating, is that, there's a lot of generalization. Yeah, fintech businesses, or SaaS businesses don't require much capital. It really depends. The devil's in the detail. And so I was operating a MarTech business where we were subject to the famous chicken and the egg problem. We first needed a larger audience using our service in order to be able to monetize that audience. And that requires relatively more capital than another type of business. And in this case, access to external, you cannot bootstrap such businesses, quite simply. And this is where I found quite frustrating that in the UK, even though the UK tends to also be a hub for marketing activities, I wasn't able to find the right type of investors, having met in excess of 300 to back our vision. While, as we speak, you have 2 unicorns in the US doing the same thing.
Final question. You mentioned the fundraising climate and, raising in the UK and the US. And we know that in the US, it's a little bit easier. I think I read a stat, something like 1 million in the UK for every 5 million you could get in the US, something like that. Essentially, it's much easier to raise. So what would you say is your observation of raising within the UK and UK investors, and how have you managed to go about that successfully?
So it's a paradigm shift, as you rightfully allude to, raising here versus on the other side of the pond. And then it all starts with mentality. Going bankrupt in the US is not something that you're stigmatized for. If anything, it's your claim to having tried. And I love that. I love that because you don't control everything in life. You may be the brightest, the sharpest, the most hardworking, but the one thing you don't determine is being at the right place at the right time. And so, right? And so you need the best environment for entrepreneurship is one where if you failed, if anything, it's heralded as you giving it your best, and as importantly, a lesson that can only make it more likely you're going to succeed at the next attempt. And therefore, investors, they spend less time going through the details of a business plan that actually has very limited value, especially at an early stage, and they more appreciate one thing. Every second Aymeric spends on building the business further drives value. Every second I would use of his time to ask why he used this type of driver, not that type of driver, will generate zero value, if anything, an added level of frustration. So I don't think you can change this, not even generation. And this is why I think Poland has more of this than the UK. And then if you look at the terms, so here the terms are also much more protecting investors. And that's also not cool because we as entrepreneurs, the opportunity cost is enormous, right? It's not only we're not earning money today, we're not earning, but we're leaving aside other earnings and having to give away, liquidation preference, having to give away other types of such rights, I find really discourages true entrepreneurship. And naturally, given the US is a country that's 5 times larger, well, it's all the more conducive to being at the helm of entrepreneurship. And there is no way that we in Europe will ever come anywhere close. But what I do encourage is people like us, the 3 of us, when we decide that we're ready to nurture the next level of entrepreneurs, that we remember our experience and that we behave more like we would want investors to behave, that we have experience, if you see what I mean.
Don't black out all the memories.
Discussion for another day, maybe when we are a bit older. Going back to, so you mentioned a few things about fundraising, etc. If you had to pitch LoanTube today, what would be like the market trends at work that will make your business successful, or at least will mitigate your chances to fail? I mean, I know that today you are in such position that, the business is running. It's not like you're trying to essentially, you are not struggling to make it work. It's more a question on how to grow, etc. But what are like the key market trends at work that you bet on or you see that will make LoanTube very successful. And I'm asking with the idea in mind where essentially, I mean, if you have more and more debt and then the economical context is not necessarily great, etc., you know, if something happens like a great recession, etc., etc., I mean, do you think it will sustain the lending environment and the borrower environment, or do you think it will collapse? I mean, yeah, short question. What are like the macro trends at work that will push your business?
So because of the regulation that we alluded to that has been imposed now for a good half a decade, I don't foresee a situation where people are overly indebted because, mark my words, the people who are getting loans, they really can afford it, at least from the day that they borrowed. Now, their circumstance may indeed change, but then again, the regulation is now forcing lenders to find a suitable restructuring of the debt. And all these are very positive dynamics. What will definitely, let's say, the wind that blows in our sails consists of the fact that, unfortunately, given the state of the macro backdrop in the UK, you have more and more households who are moving from prime to non-prime. So which means households that would have never, who would have thought that borrowing at APRs in the 25% range was unfathomable. Well, today, because their earnings, given inflation and given maybe the higher mortgage compared to 10 years ago, means that they have a less net disposable income, and as a consequence, they are forced to borrow when they need to borrow at higher rates. So the market keeps getting bigger. In 2018, 25% of adults were deemed to be non-prime. Today, that statistics is 33%. That is 20.2 million adults. And by the end of the decade, so that's in 4 years from now, that statistic is meant to increase to 40%. So we want to be that first point of call for these underserved, as we call them. It can be sometimes an overused word, but really the people we serve are marginalized by mainstream finance. And we are of the view, just like an entrepreneur, you know, I had a successful exit, I had a failed business. I love when people give me a second chance. We're in the same business of giving people a chance. The one thing, though, where we must not remain complacent is at the moment, I have a simple flow business. I source leads. I do my best to convert, I earn money. I haven't yet built lifetime value. I don't have a captive audience. And so my immediate near-term priorities are precisely to start building loyalty, community, but not with the view to encourage people to borrow more. No. But to remind them that if they have a borrowing need, LoanTube is their first point of call, and that this resonates with them organically, as opposed to me having to spend a ton of money to remind them about me. And if I may, Thomas, I think this is a great time to tell the outer world about a new feature that we're just about to launch. You see, I alluded to the 360,000 people that I serve on a monthly basis. Unfortunately, only 60,000 of those get at least one loan offer. So what that means is that 300,000 of the 360 get nothing. Now, what would platforms like me in the past do? They would sell these so-called declines, services they don't need. This could be insurance, these could be like credit builders. We have refrained from ever going down that route, because even though we could make a little bit more money, it is not true to our ethos, because these people didn't come to LoanTube for insurance, didn't come to game the credit score. They came for a loan. Now, after 6 years of hard work, we understand how lenders think. You'd be surprised that your credit score is not what lenders look at when they lend to you. They look at the components of the credit score, which is how much debt you currently have outstanding. Are you on the electoral roll? Do you have any adverse events in the last 6 years? But they apply their own individual weighting. How much do you gamble? And so we're going live with a new product, which we've called it a credit enabler as opposed to a credit builder. And it's designed to do one thing, to give you instant feedback as to what few things you should change in your day-to-day behavior so that you can get the loan you wanted to get today as quickly as possible. And what this will allow us to do is to help a portion of those 300,000. I don't claim all of them because many of those are serial gamblers that are not good with money, but those that are marginalized by society by virtue of not having enough data points and knowledge, it's to graduate them towards being served. And I believe that is not only a word first, but that will deliver an amazing societal outcome.
Yeah, so you mentioned something really interesting there, which was the whole question around what do lenders look at? And that's actually, I think, an interesting perspective for anybody, because obviously the mystery of the credit score is always something that is very difficult to understand for anyone. It sometimes seems like if you have like no credit card is worse than anything, so they want to see you repay. What do lenders actually look at? I mean, here we've got a source, right?
Yes. So, Marcus, I mean, you nailed you hit the nail on the head. So credit scores, I'm not trying to be a hater of the credit score. Basically, let me give you a tiny bit of context of how the industry operates to answer specifically your question. You have 3 credit bureaus in the UK. They are called Equifax, Experian, and TransUnion. And they essentially work in the same way, which means whenever you take a credit product with any financial institution, that financial institution will report not only that one-off event to the bureaus, but your subsequent behaviors vis-a-vis that product until maturity. So that, should you try to or want to borrow in the future, the next lender to you knows how good you are with money. And these 3 bureaus, having been in operation for more than half a century, they have decided that they would share with consumers a score that, based on millions of parameters, is the best approximation of their financial health. And that is what a consumer-facing credit score is. Most banks today, it wasn't the case 3 years ago, but today, so this includes your NatWest, just like your Monzos, they will show you a consumer-facing credit score for free. It tends to be TransUnion's out of the 3 for different reasons. Now, Monzo was the first bank of this year to reveal that they would show you all your 3 scores. And guess what? With one bureau, my score was average. With another, my score was great. And with a third, it was horrible. Even though they ultimately all rely on the same data.
Interesting.
And there is only one explanation. They apply different weightings to that data. Now, going on now to the lenders, they use the same data, but they apply their own weightings. So, for example, if you're a recent migrant, like we were all at one point, the 3 of us, to this country, one way of building your credit score is by registering yourself on the electoral roll. It's actually seen as a good thing. That may constitute, let's call it 2-3% of one of the bureau's score. But I don't think a lender will care much about whether you're on the electoral roll. Do you see what I mean? And so that is why, in a borrowing need context, when you need to borrow, focusing on the credit score and on improving your credit score if you got declined is not really relevant, because it doesn't mean improving your score by 50 points will get you funded. But in order to deliver the insights that we plan to deliver next month with the launch of this new product, you first have to operate the business that we operate. You have to work closely with lenders. You have to understand how they work. You have to understand how consumers behave, why they may misbehave, and then design a product that sort of is at the intersection of all these different forces. And so that is why you can't replicate this overnight.
Okay. And so, and what do you think or take of AI right now? I mean, AI is everywhere, replacing the world. For your business, what does it mean? And is it a macro trend at work? Going back to my initial question on macro trends, is it something I mean, first, is it something you are implementing through the LoanTube platform? And do you think it will be like a massive game changer in a very short term? Yeah, what do you think about that? I mean, do you think it will help? It will be terrible. It will be, I don't know, like an obstacle? Or what do you think about AI for your specific space and specific business?
AI is unquestionably a formidable enabler, but it's a means to an end as opposed to an end in itself. Let me start by telling you what bothers me most. It's when big corporates, and you have had a few such announcements this week, announce that because of AI, they're now going to let go 10% of their corporate workforce. I'll tell you why that bothers me. It's because one thing that I learned in life, and I'm talking from the perspective of I've been 44 years on this planet. And
Congrats.
remember, I used to be an investment banker.
You're still around. Congrats.
I used to be an investment banker, which means I used to be a jerk. I now try to be led by one sort of...
Don't say that. I'm sure that there will be some investment banker listening to us.
I have huge
respect.
respect.
A lot of respect.
So don't get me wrong. I just wasn't that respectable investment banker. That's all I wanted to say. And I've come to the conclusion that, especially when you're a young business, just live with one guiding force. Treat people like you want to be treated. And so one thing when I make hiring plans and ask myself 10 times, I not only find that person, but when I do, can I make sure that they will be able to further their career within LoanTube and they're just not going to be here for 3 to 6 months?
I wasn't talking about AI replacing your own people. It was more like in your algorithm,
Yes.
including AI to make it sharper, faster, more accurate, etc.
So we have been using AI, so machine learning. We've been using machine learning since day one, because when, for example, an applicant that we send to a lender doesn't convert, basically they don't get a loan offer, that constitutes a data point that allows our system to learn what not to do next time around it's a similar applicant comes through our doors. So we've been doing this since day one. We are now using AI more for consumer-facing activities. So I mentioned that step one to applying for a loan is filling in an application form. That is a static journey today. You just answer questions. We have plugged into ChatGPT to now transform that experience into more of an interactive and conversational experience, which means that if, for example, even the question, how much do you want to borrow for? And you're not quite sure, you're thinking, should I borrow for 2 years or for 5 years? You can say, what would you recommend? And boom, you have a recommendation as to the optimal tenor for your particular need. I believe we are the first loan comparison platform in the UK to be fully integrated with ChatGPT. What this means, chaps, is that if you wanted to apply for a loan today, you could literally do so via the ChatGPT engine itself. So Thomas, right now it's these additional enhancements as opposed to a fundamental rewiring of our business.
Got it. Thanks.
Great. So I think with regards to maybe looking at more of a moral angle, so do you think it's ever right to push more credit into the subprime segment, for example? Like as long as it's transparent, of course? Or do you feel that the industry should be helping people more instead of, borrowing more, effectively getting them to borrow less? So it's similar to what you were saying about gambling. Like you said, gambling is fine as long as you control it and you only use a small amount of your income. Would you say the same applies to credit?
Absolutely. Credit must always be used in a controlled, reasonable way. I fully agree with that statement. And I have good news. I don't create demand, basically, and I have no intention to ever create demand. The demand already exists. My role is to make sure that those highly underserved people by mainstream finance can find a legitimate source for their borrowing need. Legitimate means from a fully FCA regulated lender, because it means that if all of a sudden they find their fortunes change and they find themselves in a situation where they can't pay back, there is a clear laid out plan for them to get out of this situation. If I'm not around to help these people's borrowing need doesn't disappear. What do? They go look for money through illegitimate channels, unregulated channels. This could be from a loan shark at the pub. A Fair for All finance study shows that since 2020, 3 million UK adults have borrowed from loan sharks. And 1 out of 10 of those, as a result of that experience, have contemplated suicide. So I think platforms like us are serving a very important role. And if anything, as I described with the product I'm about to launch, I'm not satisfied with where we are today. I wanna go even further and introduce that element also of education. You're denied credit for these reasons. So, if you gamble less, or if you behave better towards, let's say, your discretionary outgoings like Uber Eats and Deliveroo spend, you're more likely, I kid you not, this is one reason you may be declined, is you are deemed to overindulge in takeaway food. Because that 20-pound
I'm definitely getting declined then.
That well, you see, it's all relative, Marcus, because it's all calculated as a percentage of your earnings and of your monthly cash flow.
Okay, right.
But it's not something that you would necessarily be aware of. So it's all about nurturing responsibility towards the use of money, because ultimately that's what it is. It's not about telling you not to borrow. It's not telling you that, how to do that some people do things better. It's more about value money better. And if you value it better, you will have many more opportunities to use money to unlock ROI, a positive ROI project.
Okay.
And sorry, one last question from me, and then I'll pass it over to you. So just in terms of the information you mentioned, that Uber Eats example, so do lenders have access to that level of information within like your spending patterns, for example? Or is it just like the score plus like a few little data points? Is it anonymized data? How does it work?
So this is delivered through open banking. By allowing a lender or even us access to your open banking data, what happens is, step one is we extract the raw data and then we categorize it. The categorization is the most critical element of this data extraction, to make sure that we know what are your essential outgoings, what are your less essential. And then lenders will decide what they see as positive events, what they may flag as less desirable, and what they will flag as absolute unacceptable events. And you know what? Actually, lenders have been doing experiments where they haven't been analyzing the data. They have simply been asking, are you okay giving access to your open banking? And they have found a huge correlation. If you agree to giving access to your open banking data, it means you have less to hide than someone that is unwilling to do so. And that actually would convert a marginal decision into a positive one.
Just a quick question, two questions actually, thinking about it. Like open banking, just to understand correctly, so if you get access to my open banking, you get access to all my bank accounts, or just one specific? Because I could give you access to my Barclays account, but I have tons of other accounts on the side which you don't see, where I'm essentially using my Revolut card to go to the casino. So when you say access to open banking, it gives you access to all my bank accounts.
Yeah. So open banking, again, it's a channel. So what it is, it's a framework that allows you to share the contents of any account that you may own with a third-party service provider in a context that you fully control. So Thomas, in the first instance, you would always be asked to share your main bank account. Most of us have a main bank account, but most of us have more than one bank account. So what will happen is if the lender or even us sees outflows between two accounts, you may then be asked to provide additionally access to those additional bank accounts. The one thing that we may not be able to prevent ever is if, Thomas, you are so shrewd that what happens is you always ask your friends.
I am.
And I know you are, and that is why I'm flagging to everyone is you ask your friends to wire money to that Revolut account, let's call it, which you then, reimburse them through cash. That naturally we wouldn't be able to track. But to be quite frank, those types of instances genuinely constitute a micro minority of all cases.
I think your credit score is going down after this podcast.
I'll let you know, Thomas.
But thank you very much. So now, I mean, we spoke about the business, the trends, etc. I mean, really going back to who you are, like an entrepreneur. So you've said it a few times already, but you've had successes, you've had failures. Do you think you could walk us through a bit about on your journey, like before LoanTube? So I mean, you started in investment banking, but from the end of investment banking to LoanTube, I mean, if you could essentially describe very quickly like the different businesses you've set up, what was hard, what were like the main lessons you've learned over the years, what you will definitely not do again, what you will definitely do again. I mean, those sort of things would be quite interesting to understand. Yeah, your journey.
With pleasure. So the first thing I would caveat is, if you're motivated by money, don't embark on an entrepreneurial journey. But that was not something that I ever paid particular attention to. I just wanted to do cool things, ideally that nobody had yet done. And so after I joined full-time Bank of America in 2005, I was lucky enough to survive the global financial crisis, having contributed to it. Just to be clear, I was only following orders. And by that, I mean, I was participating in deals where we were financing businesses that could never sustain the level of debt that was placed on them. And then after in 2011, I realized that not only had PowerPoint and Excel become my best friends, but that I was my skills, my character was suited more to an entrepreneurial environment. And given my half Polish heritage, I felt like, let's move to Poland, let's take a small break, and let's build the first business from there. So I quit my banking job on the 28th of February 2011. I was the first person to hand in my resignation. And I moved to Poland having just also acquired my first iPhone. And shortly after arriving in Warsaw, I order a coffee in a coffee shop, and the person at the counter gives me a loyalty card in paper form, with a stamp, 10th coffee free. And I looked at my phone, I looked at that card, and I'm like, you know what? We're going to put that there. And that's how my first business was incubated. I had no entrepreneurial, it's called heritage. My parents are civil servants, but I'm like, you know what, this sounds like a simple enough endeavor. Oh, how was I mistaken? One of the blessings of being an entrepreneur is an adequate level, as I call it, of naivety. You don't know too much, because if you know too much, you will never do it. And so I embarked on this journey. I had some savings, so I bootstrapped that business with a former high school friend of mine. I partnered with him, and the first problem, we launched the business relatively quickly, and boom, first thing that I had completely not anticipated, I had a smartphone. 35% of Poles had a smartphone, but that meant that 65 didn't at the time, and loyalty is meant to reward all your customers, not only those that have a smartphone. So we had built what's called an efficient system, but that it could only serve a portion of a retailer's customers. And so we had to do that was our first reality check. And so we had to basically do our first pivot. That pivot consisted us of also sourcing tablets. So basically the way it worked is, you could download our mobile app, which was called Freebie, and we were onboarding small retailers, and you could collect points via that smartphone app at these retailers within their individual loyalty programs. And the mobile app would give you your status at each retailer's, how many points you have and what you can redeem the points for. And the way you would collect points is you would scan a QR code. Each retailer had its own QR code. The first pivot consisted of changing the way it worked. So basically, we gave consumers an ID in the form of a QR and retailers a scanning device. What this allowed us to do is, if you were not a smartphone owner, you could pick up a physical plastic card at any retailer and use that as your ID. The scanning device was a tablet. Given we needed, because by then we had hundreds of small business owners in our network, we decided to go to the big telecom operators and to source tablets from them, because those tablets also need to be connected to the internet. And that's when we came across one of those operators was Vodafone's former asset, which had just been recently acquired by a Polish billionaire. And during those interactions, when we were, asking to source 3,000 tablets, we happened to be at the right place at the right time, because that Polish billionaire also owned a pay TV asset. He was merging the mobile operator with a pay TV. So think Vodafone merging with Sky. And he wanted to design a loyalty program for the his combined group customers, so that they wouldn't, to minimize their desire to move to elsewhere. And he decided that he was going to buy our technology to partially power that loyalty program. And so look at that. I'm 2 years into this journey. Yes, I have to pivot. And I'm all of a sudden, I receive an offer for some decent money, not, let's say, life-changing, but definitely a decade-changing, to buy my business. And I'm like, I can do this. And I'm going to do this again. And loyalty is ultimately all about data, especially helping offline retailers where transactions are anonymous. When you go into an offline Tesco, unless you scan your Tesco Club card, Tesco doesn't know who you are. When you shop at Tesco online, Tesco knows who you are. So loyalty is especially meant to bridge that anonymity gap. So ultimately it's about data and knowing consumers' spending habits. We devised our second business, which we brought to the UK, called Zip0, and that operated also as a mobile app that would allow you to scan your shopping receipts. And in return for sharing your shopping receipts, you would earn cash rewards. And the reason for going down the receipt scanning route, it's because the one piece of data that no bank or anyone across the payment rails don't have is product level information. HSBC, when you pay by card at Tesco, they will know that you spent 50 quid at Tesco on that day. They won't know whether you bought vodka with those £50 or you bought fruits and veg for your family. And that additional level information can fundamentally power, pricing decisions of insurance products. More importantly, provide power marketing capabilities. And so, but that's one of those businesses I alluded to that required more upfront investment. And therefore, we started raising money. We raised $1.5 million from, let's call it friends and family. We launched the app, got to 30,000 users, and then COVID hit. And the one thing that COVID wasn't kind to was very early stage businesses. It was very kind to the Pelotons of the world, right? That basically managed to, make a ton of money and look where they are today, but not to the early stages. And ultimately, it wasn't meant to be. I must have knocked on the doors of investors, and nobody really understood the power of our business when, at the same time, you had 2 US-based businesses, already in unicorn land. One of them is called Ibotta. They IPO'd last year. The other is SoftBank backed. It's called Fetch. And I ultimately accepted that I couldn't control this time my fortunes. And maybe, it was something that I wasn't doing right. And it so happened that same moment when I was starting to ask myself, okay, what's next? I came across LoanTube's original founder, because we were both working from this WeWork. We became friends by virtue of being the only people working past 8 p.m. on a regular basis. I confided in him with my plans to, I'm thinking about what's next, to which he said, check out what I'm doing, and how about you join me? A month later, I signed up the dotted lines, and the rest is history.
Wow,
so
yeah, that's a great...
Sorry.
Yeah, that's a great story. And I was actually going to ask you, I speak from experience as well. So I've also had one failed business, and it's very difficult because you need to pick the moment at which you say essentially to your baby that, you know, it's not working and you need to move on. But at the same time, you're a founder, so you're going to be very tied, and you almost have to have a certain level of irrationality. Like you said, you have the naivete. You need to believe that you can definitely make this work. So what were the points where you thought this has gone too far now and I should now try to exit this business? What were the trigger points?
So, thank you for sharing your own experiences. I don't want to say I'm glad to hear you went through the same, but I'm glad that you can fully relate. It's very difficult to find that time. I have to admit, most people would argue I should have given up earlier. It was
I mean,
about
I mean, after it's always like I should have left the boat earlier, but I mean, you never know. Like as Markus mentioned, there is a lot of emotions involved, so it's very hard. Sorry, I mean, I'm
yeah.
cutting you, but
No, Thomas, you summarized it perfectly. It is exceptionally hard. And I guess it's just ultimately down to, let's say, when you probably think about, let's be fair, I think about quitting LoanTube 3 times a month. It's normal. Forgive me, but
if you're not doing that, then you're not running a business
you.
and as an entrepreneur.
Thank you, Markus. Thank you. But I guess it's when you want to quit on every possible level, including the personal. So I have a wife, I have 2 children now, 12 and 11. So 2.5 years ago, they would have been, just shy of 10 years old. And I was also looking at my relationship vis-a-vis them and how it was non-existent, because essentially home was like a psychiatric ward, if that makes sense. And I guess X months or quarters of that ultimately led me to realize that, you know what, it's the right thing to do. And also the timing of having, come across my current business partner and seeing that actually he's trusting me because of my experiences. So actually, because he saw me persevere, he saw me in that phone booth speaking to like dozens and dozens of investors just to close one final round before I decided to leave. He's like, that's the type of guy I want to work with, right? So you can't control the exact timing, but the beauty of life, especially when you now have the benefit of going through ups and downs, is that so long as you stay true to yourself, to a certain core, good things should happen to you.
So that's your main lesson.
So Thomas, so when you asked for it is, and the truth is, when you asked at the very beginning of this call for some sort of framework that maybe, could offer, I don't have one. I'm so sorry to disappoint. Other than to say, if you're motivated by money, don't become an entrepreneur. Investor, okay, but not an entrepreneur. If you're motivated by the desire to, as I call it, to leave the world a little bit better than you found it, then and ultimately just be yourself, work hard, treat people like you want to be treated, and bulldoze your way through, and don't listen to the naysayers. Apologies if it sounded cliche.
No, I think that's been super useful. And I 100% agree with that. It's so important, and I think it's a part that a lot of founders have that point, because we know that 90% of businesses don't succeed. So most founders actually have the point when it's gone, too far, and they have to make that decision. So really appreciate you sharing that.
And I'm so glad to be speaking to the both of you, because you are the best possible audience to this type of interaction, because both of you have gone through the exact same journey. And I'm glad we can relate, we can largely relate. The one thing, maybe one final thing I would love your 2 cents on, and let me give you mine, is, how much emphasis should you place on a co-founder? So for example, I could not imagine running or building a business without a co-founder. I'm that type of guy. I absolutely feed off a second person. Now, it's very important to ideally have complementary skills, but I'm not the type of guy that would be able to go about it alone. What do you guys think?
I agree. I think it's a requirement as well for some VCs. I know they need you to have a second co-founder. Some invest in single founders. So even from the fundraising perspective, I know that it's harder to raise, but ultimately I completely agree. You have to have a separate viewpoint. And ideally that person is different skill sets and different personality types to you so that they can challenge your view. I agree. I don't know, Thomas, what you think?
For me, I mean, yeah, it's important to have co-founders, but I mean, I don't consider like having tons of experience with that matter. But my point of view today is probably start something on your own and then have your co-founder comes at a later stage. In the sense that if you start with someone, I mean, you may not necessarily know or anticipate the different skill set you will need at the beginning of the journey. I think it's very important. I mean, very important. I don't know, like maybe I think one of good situation is to start maybe on your own. And then once you've identified what sort of skill set you need, this is where you have someone else like coming in. But then I may be completely mistaken. I mean, there are like super success stories of people like starting together, and you also have like a massive failure of the same, following the same pattern. So I don't know.
When I listen to both of you, I guess there's room for both. And it also is down to who you are, right? Like I need from day one someone. But Thomas, I fully appreciate that if you're not in that position, if you're not Aymeric, and you can, then probably your approach is more optimal. But I guess you just have to listen to yourself, right?
Yeah.
Yeah, it's
And
not
every
necessary
business is
to-
different. Yeah.
Yeah, it's not. Yeah, exactly. So it's not necessary to yourself. It's also what you're trying to build. So I'm not a tech person. I mean, I wouldn't know how to code anything today. So if I had like an idea on or a project of building like an AI product, it wouldn't be me. So first thing I would have to do, explore the market, but then in parallel find the person who could execute on the product. Yeah, it depends on the situation, I guess. So maybe going back like to what you've learned in terms of recruitment, etc. I mean, do you have some sort of a playbook when you want to recruit the right persons, etc. for your teams? And over the years, I'm sure, I mean, you've recruited tons of persons, so you may have hired like the wrong ones, the right ones. Maybe sometimes you had some good surprises, bad surprises. And based on all of that, I mean, do you have some sort of a playbook now you follow with recruitment, for example?
I was definitely guilty of probably one of the most common mistakes at the beginning of my entrepreneurial journey, where I was placing way too much emphasis on people with beautiful CVs. So some of the most senior people I hired for my first business were people precisely who, on paper, they were superstars. But I completely failed to acknowledge that they were not necessarily going to be superstars in an entrepreneurial setting where you don't have clear processes, where you don't necessarily have a strong brand image, and so on and so forth. So I then went the other way, and I started to massively de-emphasize these types of people and looking for raw talent. And I think at the current stage, it's about striking that fine balance. And also with age and with experience, I feel that, you can, it becomes easier to find the people that are a right fit for your organization or not. One thing that actually has been very helpful for us at LoanTube, it's because we're bootstrapped, we can't afford market rates when we hire people. And so that means hiring projects are significantly longer, but ultimately it means that we find people who are really, at least in the initial phase, driven by the mission more than by the paycheck. Of course, as they drive value for us and they demonstrate an adequate level of loyalty, it's only right that we reward them with stock options. But actually, I find that it's a hidden blessing to not be able to recruit too quickly, at whatever price somebody quotes.
Okay, understood. So, I mean, it's part feeling, part process.
Indeed. And I have worked with a few headhunters in the past, and those experiences have been, to be mild, to be less than satisfactory.
Catastrophic.
Those words
Is
came
what it
from
means.
you.
Okay. I mean, maybe to sort of, close down the conversation. What are like your small habits? I mean, things you do all the time, like almost like like mechanically that helps you, with your discipline, etc. I mean, something I've learned personally is to try to have a very strict discipline, because even though you are passionate by your mission, by your product, by your company, very often what will help you make it through is really discipline. I mean, you may not want to like to go to the office every day, but if you have a strong discipline, it's really something that will act as some form of an engine, particularly when it's hard. So what are those like little habits you have, or maybe every day, or maybe a few times a week, that essentially helps you go through hard times and build up on your discipline?
Thomas, firstly, I want to say what you said was brilliant. I couldn't agree more. I agree. At the beginning of my entrepreneurial journey, I was like, you know what? The beauty of being an entrepreneur is also you can choose when you go to work. Well, actually, no.
You're always at work.
You're indeed always at work. Make sure that it does to internalize this reality, because if you're not, then don't torture yourself. But on the discipline front, Thomas, I used to be the type of guy that I would occasionally, like, for example, work out hard, let's say once a week. And I've realized that actually once a week doesn't do any good. So right now what I do is I religiously work out once a day. Just to be clear, it's a mini workout. It's either a 2-kilometer run, which I believe you've seen me run twice, or at least once. And on the alternate days, it's a set of 12 30-second exercises. So that lasts 9 minutes. But by doing so on every alternate day with no excuses, irrespective of how I feel, the weather, I find that sets me up much better for the day, and also trains my workday habits, because I see how it's all about the concept of compound interest. 0.1% in any given day may not be much, but if you compound that on every single day for a certain amount of time, that amounts to a ton of value. I guess, Thomas, I'm just confirming that one sort of habit that you alluded to, which is so instrumental. And then the second one, which is way more personal, is I feed off of interactions. So I'm the type of guy that I must make sure that I have at least one interaction a day, ideally at the beginning of the day. It helps me wake up. So for example, I don't work from home, not only because of the children, but also because I need to get out of my shell. I need to get out of that, that sort of self-imposed comfort zone. And then aside from that sort of little workout, if I can have a really cool interaction, like this, but on a smaller scale at the start of the day, I'm then set for the day. And often I don't want the day to end, which I'm also guilty of, but that's for another time.
Super. But look, on that super healthy note, thank you again for being with us. So thanks, Markus, again, for being with me and supporting me. And really, thank you to the Aulium community. And I hope you will enjoy everything you've heard. Cheers.
Thank you very much, guys.
Thanks, Aymeric.
Take care.